Hi everyone, welcome back. Before we begin, just a quick disclaimer. This video is for educational and research purpose only. It does not constitute financial advice or an investment recommendation. All strategies shown here are hypothetical and based on historical data. Past performance does not guarantee future results. Please do your own research before making any investment decision. Time series momentum has been extensively documented in academic literature as a persistent and economically meaningful return premium across asset classes. However, practical implementation often suffers from methodological weaknesses, including survivorship bias, look-ahead contamination, parameter overfitting, and insufficient out-of-sample validation. This notebook presents an institutional-grade implementation of a long-only time series momentum strategy applied to a multi-asset equity universe. Key methodological safeguards include the dynamic universe handling, explicit signal lagging to eliminate look-ahead bias, equal weight allocation across eligible assets, transaction cost modeling via turnover, walk-forward out-of-sample validation, rolling Sharpe stability diagnostics, rolling drawdown analysis, rolling CAPM alpha estimation versus SPY, rather than focusing solely on maximizing backtest returns. The objective of this research is to evaluate structural robustness, temporal stability, and the persistence of economically grounded alpha. The core research question is, does time series momentum generate durable excess returns after controlling for market beta, exposure, and realistic implementation constraints? The following analysis aims to answer that question through a comprehensive multidimensional validation framework. This project started with a simple idea. Markets might exhibit structural intraday inefficiencies, especially around gap behavior and short-term price adjustment. Instead of trying to curve fit parameters to maximize returns, I wanted to test this idea systematically, so I built a framework that allows the strategy to be re-optimized monthly and tested on an unseen data. Backtesting framework. The most important part of this project is not the strategy itself. It's the validation framework. I implemented a strict separation between in-sample and out-of-sample data. Every month, the model is optimized using historical data and then immediately tested on new, unseen data. In total, I evaluated more than 1,400 parameters configuration across 26 years. The goal was not to find the best parameter. The goal was to test the stability. Full sample results. Over the full sample, the strategy achieved a Sharpe ratio of about 1.05 and a CA share close to 18%. Those are solid numbers, but full sample performance alone doesn't mean much. Many strategies look great when you optimize them on the entire dataset. So the real test is what happens out of sample. This is the most important chart in the entire analysis. What you are seeing here is purely out of sample performance. No in-sample equity is included. The strategy grows from 1 to almost 6 over the testing period. You can see flat periods, you can see drawdowns, you can see acceleration phases. That's realistic behavior. And more importantly, the growth persists across multiple market regimes, including the 2008 crisis, the 2020 pandemic, and the volatility after 2022. That persistence is what matters. Sharpe stability. Now, let's talk about Sharpe stability. The in-sample Sharpe ratio was around 1.05. The out-of-sample Sharpe was actually slightly higher, around 1.17. That gives us a stability ratio above 1. In practical terms, this suggests the strategy is not overfitted. Usually, when strategies are over-optimized, the Sharpe drops significantly out of sample. Here, that didn't happen. Rolling 36-month Sharpe. To evaluate consistency, I computed a rolling 36-month Sharpe ratio. This helps us understand how performance behaves through time. As expected, it fluctuates. No strategy performs perfectly every year. But the key observation is that the Sharpe remains positive across most market environments. That indicates a structural persistence, not just temporary lack. Drawdown. Now let's look at drawdowns. Drawdowns are inevitable in systematic trading. What matters is how deep they are and how quickly the strategy recovers. In this case, drawdowns are controlled and recovery periods are relatively fast. That's critical for real-world deployability. Rolling CAPM alpha. Finally, I estimated rolling CAPM alpha. The question here is simple. Are these returns just market beta? Or is the strategy generating excess returns? The rolling alpha remains positive across most periods. That suggests the strategy may be producing returns beyond passive market exposure. Final conclusion. The empirical results suggest that the implemented time series momentum strategy exhibits a structurally robust performance characteristics. Key findings include full sample Sharpe ratio above 1.0 with economically meaningful CAGR, out of sample Sharpe exceeding in sample performance, no evidence of structural performance collapse across regimes, moderate and recoverable drawdowns, persistently positive rolling CAPM alpha over most of the sample. The walk-forward framework confirms that the majority of performance is not confined to a specific historical window, reducing concerns of overfitting or regime dependency. Rolling diagnostics indicate that while performance intensity varies across macroeconomic environments, the strategy does not exhibit prolonged negative alpha regimes. Importantly, the excess returns cannot be fully explained by passive market beta exposure, supporting the presence of genuine momentum-driven alpha. Although recent alpha compression warrants monitoring, the overall evidence supports the hypothesis that time series momentum remains a structurally persistent phenomenon within large cap equity universe. From an institutional perspective, the strategy demonstrates risk-adjusted characteristics consistent with systematic trend following overlays rather than data-mined artifacts. Future research direction may include deflated Sharpe ratio adjustment, bootstrap confidence intervals, Monte Carlo path perturbation, regime classification modeling. Overall, the findings reinforce the economic viability of disciplined, systematically implemented momentum strategies. If you are interested, the full notebook is available in GitHub, link below. Thanks for watching.